Hi, good afternoon, good morning, everybody. This is Sean Ewing here with the marketing department at SitusAMC. Just want to take a quick moment, thank everyone for joining our quarterly valuation trends first look webinar today. Later on, we'll be emailing out a copy of the slide deck along with a recording of this webinar. With that said, I'm proud to present our hosts, Peter Muoio, PhD, and Jen Rasmussen, PhD. Take it away.
Thanks very much, Sean. Good day, everyone. We're here in the first month of the year. We like to do our sort of look forward with the first data out that we've published covering, the end of 2024 and indications of where we're heading. In many ways, 2024 was something of a shift towards stability. Interest rates, at least on the short end, started coming down. We've still seen something of a roller coaster on the long end. Economy continued to grow. But there's always the known unknowns and the unknown unknowns, and the known unknowns include a new administration, and we're not sure quite, where the various policies will land and what the impact on commercial real estate will be, as well as a lot of, continued always, right, geopolitical uncertainty. So with that, what I'd like to do is start off with some of our macro trends, and then get into the really heart of the matter, which is what is our data showing among CRE investors and lenders. So the first chart is something that we introduced on one of the webinars, I believe, last year. It's what we call our dynamic population tracker. One of the issues, when you get down to the metro level, is that population data is always, very much out of date. It's like a year and a half before the census tells you what's been going on. And for so much of commercial real estate, the demographics is destiny thing is really very important. And so being able to gauge, what's happening to population in a more, up to the minute kind of way, we think is very important. And so we developed this tracker, which makes use of a whole host of different indicators, things like, post office address changes and electricity hookups and bank account openings and moving van movements. And I think it's really tracked very well, with, what subsequently the population data has shown. So what's the latest? What we're showing here is what's happened over the past 6 months. And we do it in this heat map fashion where it's color coded and number coded. Dark green means strong growth. Then we fade towards white and then into pink and red, which is weaker population growth. The other indicator on these heat maps is the arrows. Is the growth, whether strong or weak, getting better or getting worse? So what do we see? First off, you can see that big sort of green swatch sort of towards the middle. That's the Southwest, where population continues to grow strongly. The Texas metros and Phoenix have experienced solid growth over the last 6 months by our tracker, and all rank in the top 10 of the 50 largest metros. The West Coast population, while still weak, has actually improved, and you can see that in the upward arrows in a lot of the West Coast metros. By contrast, the previously strong population growth in Florida is now mixed. We're still seeing strong and improving growth in Miami and Orlando, but we're seeing slowing growth in the other major Florida metros. Interestingly, New Jersey, New York City, the Northeast, parts of the Northeast are seeing an increase in population, now hovering more near the center of the rankings than towards the bottom where they have historically been for quite some time. This might reflect some things that we've been talking about, the end of sort of purely remote work. I mean, we've shifted in a major kind of way towards hybrid work. Now increasingly movements further to return to office work, at least some days of the week. And that actually, starts pulling people back from far afield places that they went to amid COVID and pure remote working conditions, and back towards some of these sort of major population centers. Looking at the Midwest, with the exception of Indianapolis and Cincinnati, the Midwest is seeing slowing and weak population growth. The next sort of broad macro trend that we wanted to really touch on, so important for everyone in the commercial real estate space is long interest rates. The chart here on the left shows the 10-year Treasury rate, and it was really off to the races in the new year. You can see sort of that sort of pop in the 10-year Treasury that began in the aftermath of a very strong December employment report. Between January 13th and January 24th, the yield has started to come back down, as you can see, about 20 basis points amid lower than expected core inflation, which you can see on the chart to the right. The yield slipped another 10 basis points yesterday as investors sought safe haven amid a stock market sell-off among the announcement of the Chinese AI model that may outperform OpenAI model and really sort of led to a rout in tech stocks and the broader market. So where do we stand? As you can see from the arrow on the chart here, long rates are as high as they were back in spring of last year. So there's been a lot of optimism in the market, and this is actually going to sort of come through in the next chart that I'm going to get to. There's been a lot of optimism among CRE participants that rates were coming down, and they have on the short end of the curve. Long rates remain high, and so it's sort of going to be interesting to see how that plays out in terms of thoughts on, how the market progresses, how the CRE market progresses in 2025. So to that point, this is the chart that we show each time. It indicates the investment alternative preferences among the major asset classes: stocks, bonds, commercial real estate, and cash. The black line here is commercial real estate. In 2024, through the first 3 quarters, saw a very sustained and solid improvement in the attractiveness of commercial real estate. And I think, getting back to the point I was just making, what 2024 really was all about in many ways was the end of rising rates and the sort of lower rates on the horizon, and that created a lot of optimism for commercial real estate investments. And what we see for the fourth quarter data that was just released a couple of weeks ago is that has edged off some towards the end of the year. And my take on it is that the disappointment in where long rates had ended up after the whole sort of roller coaster that we did see last year led to some tempering in the expectations about or the approach to how attractive commercial real estate was going to be as an investment. This chart shows our data on equity on the left and debt on the right, capital availability and discipline. One of the things that's clear here is that the discipline side of the equation for both equity and debt, which is the purple lines in each of the charts, continues to show that underwriting standards, broadly stated, have started to ease. Unfortunately, the availability question became somewhat tighter as we finished out 2024. Both equity availability on the left and debt availability on the right ticked back down. And so there's still tightness in that sense in the market in terms of the propelling transaction and lending activity. This chart to me continues to be super interesting. We really started highlighting this a few quarters ago when we saw the unprecedented high degree of hold, which is the light blue line on the chart here, begin to ease off. What you can see now is that as we ended 2024 in the fourth quarter, that really has accelerated. So we're down to 56% in the hold recommendation. And a lot of that movement sort of away from hold is going towards buy, which is the dark blue line, which increased to 33% in the quarter. But you can also see that sell has come off the floor. So we've said it before, it looks like it's still in the process of happening, that the ice is breaking. I wish I could say that up here in the Northeast, but the ice is breaking in terms of the potential for deal flow to get going. And I really do want to reiterate something that I've said previously, that sort of the interest rate story is a key ingredient in this actually starting to show through, more strongly in the numbers. So the next thing we have is a poll question. We wanted to ask all of you, what property type is the best investment opportunity over the next year? I'm just going to give a little bit of a hint, not a hint, but this is something that as we've looked at our data, the story has shifted several times over recent quarters. So as we stand here today in January, what's the best property type? What property type is the best investment opportunity over the next year?
Yeah, we've got that poll open now. We're getting a great response rate from the audience. We're going to leave it open just for another 10 or 15 seconds here for anybody who's taking that additional time to think it through. But yeah, interesting response so far. I'm curious to see what you guys have to say. All right, we're going to give everybody just a few more seconds here.
You're tantalizing me, Sean.
I'm trying to build it up.
Well, look at that.
So I don't see it because I'm in presentation mode here. So what do we, Jen, do you want to walk through what we're saying?
Well, the number one is apartment at 42%, and then we have industrial at 27%, and office and retail similar. Retail's at 17 and office is at 14.
Okay, this is very interesting to Sean's point. When we asked this last quarter, the results were, office at down low at 8%, retail 22%. Apartment was the big number there. It was 36% last quarter, and retail and industrial was 34%, almost, basically tied with apartment. Where did you say apartment was this time in the poll, Jen?
42%, number one.
Okay, well, as you can see here, you folks are all sort of, echoing what we're getting from our survey, our very big survey results as well. The industrial this time around is 41%, and sort of nudged out apartment, but apartment is still up there at 33%. So, these have been the darling property segments. They continue to be the ones with the, sort of the best space market fundamentals, and we'll get into that in a little bit. Industrial had its moment where people sort of eased off it and sort of were looking at retail to a greater degree for a while, but it's sort of come back to the fore in terms of space. Now, what will be interesting is whether the developments, the ongoing developments since yesterday in AI and the potential impact on data centers and the like, if there is to be one, changes that as we move forward. Jen, did you want to take the next few slides?
Happy to pick it up. So this is the up to December, so hot off the presses, data from MSCI Real Assets, formerly known as RCA, on deal activity. And at $55.7 billion in December, we saw overall CRE deal volume up almost 59% month over month. And this was the highest level since December 2022. The caveat, and Peter and I were talking about this yesterday, is this is likely due to that typical end of year rush to get the deals done. So we're going to see how this plays out over the next year, but I do think it's encouraging. And we are seeing that all major property types experience this increase in December. And that's particularly true for office activity, which more than doubled over the month. I think investors are taking advantage of some of the low pricing going on in office, and we're going to see that on the next slide. If we look at it on an annual basis, volume was up year over year for all segments.
It's interesting, folks. I don't know if you saw in the Wall Street Journal today, there was an article on the office segment and sort of renewed interest in it, which also dovetails with some of the data that we were showing in terms of, segment preference, but also in terms of, this initial data of, prices have come down, there's capitulation, there's the distressed product coming through, and I think this is adding to having more office transactions in the mix. Go ahead, Jen.
All right, on the next slide, we see that overall commercial real estate prices remain steady month over month, and that kind of ties into our theme of stabilization. The apartment prices were essentially flat at their lowest, but still at the lowest level since July 2021. Retail did have a month over month growth of 1.1%, and that's marking 7 consecutive months of increases. And with a 0.5% month over month for office, we're now seeing office prices at the lowest since 2016. Industrial prices also fell slightly over the month. Looking at it over the year 2024, though, retail and industrial pricing has outperformed the other segments. Retail's up 3.2% and industrial up 2.7%, but office and apartments have dropped over the past year. And if we would take a look at the cap rates on the next slide, we're kind of seeing this transition to stability, I think, in cap rates as well. All segments except for apartment were stable quarter over quarter, and apartment was just up 10 basis points. But the trend for apartment, which you see in that orange line, has been kind of stable over the past year or so. That being said, caps are still elevated. They're roughly around the level seen in 2011, 2012, as the CRE market was emerging from the GFC. And I wanted to show our alternative property cap rates on the next slide. So in general, cap rates for all alternative property types have outperformed their traditional counterparts. That's something that we've seen pretty consistently throughout the last couple of years, except data center. The change from the peak for data center is a little bit lower than the overall industrial segment. And yeah, I think we're seeing that slower pace of cap rate compression, although the trend line is still following something like self-storage. And with data center cap rates higher to begin with, I think there's a little more cushion or wider spreads above the debt base rate, so investors can accept these higher caps. Still seeing a lot of demand, though, for data centers. And we go into our next poll question. So how will overall CRE distress change over the next 6 months? So this is overall CRE distress for all types of loans.
Yeah, we've got that poll open now and getting a very good early response here. It's interesting seeing the response rate shift and change here across the 3 options. We'll leave that open for another 10 or 15 seconds here. But yeah, curious what you have to say about it, Peter and Jen. It's interesting.
Yeah, we'll see if people have a glass half full, glass half empty, or just glass half.
Well, I'm not able to vote, but I am usually a glass half full kind of guy. And let's take a look and see what our audience thinks.
Interesting. 40% are expecting it to stay distressed to stay at the same levels, and then kind of close behind that, we have 31% saying it'll increase over the next 6 months, and 29% saying it'll decrease. Let's take a look at some data on the balance of distress. So looking at just overall all outstanding CRE distress as of 4th quarter, it reached $107 billion. And looking at that chart, I don't think it's a big surprise regarding office. Office and apartment are actually about the same percentage when you factor in potential distress. So I think apartment is really the interesting story here. And when you think about it, the segment has faced some headwinds over the past year or two. But looking forward, about 40% of the total debt maturing in 2025 is multifamily. And we're looking at deals that were made during the heyday of apartment back in 2022. They typically had a 3-year debt term. So the segment is facing a lot of potential distress, a lot of maturities, and you couple that with those persistently high interest rates, the falling prices, and the challenge fundamentals over the past year. I think that's where we're seeing that huge potential distress there. Looking at these data historically, though, we have seen that the pace of these increases in outstanding distress has been slowing. So compared to the first 3 quarters of 2024, this last quarter is actually on average a slower pace of growth. So
well,
with
that sort of dovetails, Jen, with the result that a lot of folks out there think that things are going to stay around the same. It's sort of, again, this transition to stabilization theme. With that, we'll get into the property segments. We're going to actually start with apartment. And Jen didn't mention this in the thing, but one of the issues that we hear a lot from investors and lenders that we work with in the multifamily space has been cost. So go ahead, Jen, if you wanted to highlight this slide.
I don't know if I want to highlight it. It's not particularly good news, but it's important to talk about. So these multifamily expenses, we're looking at it on a per square foot basis. They've grown significantly, particularly since the beginning of COVID. And we're seeing that the high expenses driven by growth in insurance, maintenance, and administrative costs. And the sustained upward pressure on operating expenses highlights the critical role of strategic asset management in maintaining property performance and returns. On the chart on the right, we excluded property taxes. Property taxes are the highest expense for multifamily owners, but we wanted to focus kind of on the things that landlords can generally control. And I think it's interesting in there, we see that I think the most fascinating thing is the insurance premiums, which is that purple line on the chart. We see this huge bump up, and it's sort of leveled out now. But gosh, Peter, you and I, we hear internally all the time, we hear it from our clients about the rise of insurance costs. And we're seeing that a lot of these major insurers are raising rates by 50%, maybe 100%, although like I said, it's leveled out in the past couple of years. But some of these major insurers are even canceling policies just to compensate for the greater amount of risk. And I know lately here we've been seeing commercial real estate policy holders flock to the insurers of last resort in their states. So this is definitely a major topic. We're going to explore this in more depth.
And obviously, I think the tragic fire situation in California this month is not going to make this situation better. And not just in California. There's going to be spillover effects, nationwide. This sort of perception of enhanced risk from disasters of all sorts, including fires, is going to work its way through the system. So to Jen's point, we saw that big sort of push up since like 2022 or so, and things stabilized a little. Would not be surprised to see this take more legs up in the aftermath of the LA fires.
Absolutely. I'm going to go through this next slide pretty quickly. I think that this speaks to just investor optimism on multifamily, like we saw with our ratings on the best property type data. Apartment share of total volume remains strong at about 35%. It's much higher than we saw during the pre-COVID years. And multifamily originations are starting to pick up. And then we'll go into our forecast for apartments. In general, I think we're going to see fundamentals starting to improve. So when we look at this compared to last quarter's forecast, we've made upward revisions for absorption and completions. And then the vacancy forecast was unchanged from the previous quarter. And this particular forecast is showing that apartment vacancies will start to drop below the long-term average by 2027. And we're seeing upward revisions in our forecast for rent growth. Rent growth should steadily improve over the forecast period. And lastly, for apartments, wow, look at that green. So similar to the dynamic population tracker, green is good, red is bad. And on a quarter-over-quarter basis, we're seeing improvement pretty much across the board. And I want to highlight, this is when our NOI outlook heat map moves forward the following year. So these are our outlook through 2028. I'll pass it over to you.
Thanks a lot, Jen. On the office front, we just wanted to sort of highlight, everyone talks about it, but the situation is as bad as we're all talking about. Wanted to give some market perspective for the overall office sector in the from the current cycle peak to where we are right now, the trough so far. Market value has dropped from 105.4 billion to 58.2 billion. For comparison, during the Great Recession, office values dropped from 65.9 billion to 41.1 billion. So the 45% drop this time around is worse than during the in the aftermath of the first Great Financial Crisis. And that's what we're seeing, sort of the out of favor element that we've been talking about for some time in office. Looking forward, what does it look like for the office maturities coming down the pike? This is data from Moody's Analytics that we were using, and it just looks like it's going to be difficult for a lot of office to refinance because of poor performance, and that's whether because the debt yield is less than 8%, or because there's significant lease roll, it's already in special servicing, REO, et cetera. So, more to come on office. There's good news, bad news here. As the article in the Journal today said, people are bottom fishing. Stuff comes out of, from the distressed market at significant discounts. People see opportunity. And, one of the things that I'm just going to skip to is the story of, conversion. Now, this shows a big jump, but the 2025 plus is talking about the number of office conversion projects currently into the future underway. So it's a little bit of a non-single year kind of thing, but it's clear that planned and announced and underway office conversions are starting to add up, and we see it with more and more of the clients we talk to getting involved in raising funds for money for funds that are dedicated towards it. A lot of municipalities changing zoning requirements and changing even providing incentives and the like for office conversion. So it's one of those things where it doesn't happen, and then it starts to happen after everyone sort of figures out how it can happen. And that seems to be the place where we're in right now with the sort of office conversion story. Just this week, I think it was, New York City, rezoned parts of Midtown Manhattan to make it more favorable to add residential into what was formerly purely office using space areas. So these kinds of things are happening, and it's going to be part of the process by which office sort of makes its way back from where it's at now. We don't have a chart on it for this time, but I was just thinking in terms of the announcement by the federal government, return to work. There's a lot of sort of chatter that can have spillover effects as well in terms of either regulated entities, companies, or companies that do a lot of business with the federal government, sort of starting to match, the federal government's, movement in this direction, and that sort of just snowballs and snowballs and snowballs. So there's a degree to which it's the beginning of, a sort of higher office utilization, period than what we've been in. So the outlook that we show here is not a lot of different from what we've shown in the past, so I won't spend a lot of time on it. Very high vacancies, even not in a recession, and improvement as we, look forward into, 28, 27, 28, 29, but still at a very high level and minimal rent growth. And so, Jen says red is bad, green is good. It was a little more green, a little more white, a little pinkier, right? It's more like sort of medium rare instead of rare. But there's still time, a lot of time for a lot of markets for Office to go through the sort of transition to better fundamentals.
And so I know we're running short on time, so I'll quickly go through the industrial segment. This first slide, I just want to show this. These data come from a Deloitte survey of transportation and manufacturing executives about shifting Asia originating freight to closer proximity markets, or that nearshoring. And these executives are expecting, a doubling of moving freight originations by 2030. The caveat is this study was conducted before the last year's election, so it's going to be interesting to see if, when, and how tariffs will affect this. And on our forecast front, what we're seeing here is that industrial's explosive growth is ending. Vacancies are expected to remain above 6% through 2026. We also see that rent growth has cooled, but it does look to improve. And that ties into our heat map for industrial. So we're seeing general improvement across all regions. You'll notice Pittsburgh, Portland, and Sacramento are the laggards, suffering from particularly acute oversupply, leading to meager rent growth. And last but not least, retail.
So this is showing some more data from Deloitte. Retail executives are expecting operating profit margins 2025 to increase modestly. 8 and 10 say that. And expected year-over-year industry revenue growth in 2025, most say 5% or more in terms of for the year. So sort of a positive expectation for the profits and revenue on the retail front. The Financial Well-Being Index from Deloitte captures changes in how consumers are feeling about their present-day financial health and financial security. Unlike consumer confidence, which often focuses on consumer opinion about economic conditions, the Financial Well-Being Index focuses on the consumer's own financial experience. Some improvement, modest improvement here over recent months. Sort of a generally upward trend here. So that's a positive as well for continued retail spending. So the chart for supply and demand and rents are very much similar to what they were in the past. We didn't make a lot of adjustments to it. You can see here, sort of a steadily trending down in vacancies and improvement in rent growth. And that's showing up now in the heat map, which is the one on the right is the updated one. And you can see here, there's a lot more white. There's even, LA popped up as green. So an average score that's improving, still not great, but reflective of the generally improving trend within retail space market fundamentals. So with that, I know we went a little bit over. We thank you for hanging around, if you could. And over to you, Sean.
Yeah, thank you so much to our audience, and thank you, Peter and Jen, for a thoughtful and engaging presentation. As a reminder to our audience, you can look for that follow-up email a little bit later on with a copy of the slide deck and a link to a recording of this webinar. If you'd like to learn more about our research, or you have any colleagues you'd like to add to our distribution, you can reach out to connect@SitusAMC.com, and I'll be happy to make a connection there. Thanks again, everyone, and have a great day.
Thank you, everyone.